Sole trader, partnership, or limited company. Which kind of business structure is right for you? What are the pros and what are the cons? And even before you consider choosing up any of the structure to start your business with, then what are the tax implications that you need to keep in mind? Because each one has a different tax position. So let's discuss it today, and we are also going to see some of the calculation with different type of income level and what the tax burden is on you with that business structure. So let's discuss it today. Firstly, let me talk about one of the most common and one of the most simple business structure that often businesses start with, which is a sole trader. Okay, so sole trader, as its name suggests, you are the individual, you are running the company. It is owned and operated by one individual. Okay, it is owned and operated by one individual. So let's say I am running a business. Uh, Hypothetically, for this video, let's say I am running a furniture business. So I am owning that business. I am managing it completely. Okay, and there isn't any distinction between me and my business. We are typically the same. There is no separate legal entity between us, right? Me and my furniture business is one person, right? The business and owner are same. The owner, me, I am solely responsible for the profits and losses that I am having during the tax year. So let's say if I'm having profit of, let's say, 1 lakh pound, right? It is too much, right? So all the profits are with me. Yeah, you have to consider the tax that you need to pay to HMRC, which is too much. Okay, the hefty amount of taxes. So after paying those hefty amount of taxes, whatever is left is all with me. I have nobody to share with. And the individual person running the business, all the profits are with me, but again the losses are with me, right? I have to incur. So if my business incurs loss, I am bearing all those losses, right? As a sole trader, I am responsible for all the losses. If we talk about liabilities, liability is one of the disadvantage of sole trader, right? Because here the liability isn't limited. Okay, the liability isn't limited. So let's say my business is uh, does have many creditors and bank loans, and it cannot fulfill its obligation on its own, right? My business does not have enough cash reserves to pay off those liability, right? So my personal assets can be taken up by the creditors, right? The personal assets, my personal bank account, so not just the business bank account, they can even chase my personal bank account, my personal house, my personal motor vehicle to recover their money, right? In that way, our liability is unlimited. Okay, so as a sole trader, your liability is always unlimited. You are registered via self assessment. So normally when you file tax return, it is similar to that. You report your business income. So whatever the incomes that I've earned during the tax year would be reported there, less the deductible expenses that my business has got. This deductible expenses part is a separate set of discussion, which we could do in another video if you want. So let's comment down if you need it. Okay, so you file it. You file SA 100, which is called as self-assessment tax return. Okay, we have discussed about individual taxation as well, the basics of individual taxation in UK. You can check out that video. So what happens is the tax year is from 6th of April to 5th of April. So whatever the profits you are earning, and then would be taxed on the basis of that tax period, right? And the return should be filed, and the due date is 31st of Jan of next year, right? So let's say for tax year 25-26, I need to file my self-assessment by 31st January 2027. Okay, so in this way, your business profits are reported here. Okay, you are liable for income tax. The slab rate are 20 percentage for 12,570 to 5270, right? The 12,570 is the personal allowance that you have available, and up till 5270 you have 20 percentage rate band, and above that you would even go to 40 percentage and 45 percentage. So these are as high as 45 percentage when the profits increases. Okay, shortly we are going to discuss the part where we are going to see the calculation of how both of the different structure works. Okay, you also are liable for class 4 NIC contribution, which is again at basic rate band is 6%, and above that you would be paying 2%. So any profits above 50 to 70 would be liable for 2% of national insurance contribution, right? This is not another thing which is the latest amendment. This is not related to this video, but just to update that with MTD coming in with the next year, okay, it is coming soon. Uh, as a sole trader or self-employment, if your turnover exceeds £50,000, okay, then you will need to file quarterly updates with HMRC, right? And and at the end of the year, right, you file the final accounts with them, right? uh, it is not for the reporting purpose, right? That we reported to company's house, no, right? But still we need to keep the records digitally. Okay, we can have softwares like Xero, QuickBooks, and Sage who support making text digital. So this would be essential for the businesses having income. So sole trader or self-employment employed business, either you are earning property income, so over and above that threshold of £50,000, MTD is compulsory, right? This change is compulsory. Okay, and the threshold would reduce as we go year on year with the next year. So this is the thing that you need to keep in mind as a sole trader. Okay, and this is the revenue that we are talking about. It is not the profit. So if your revenue are more than £50,000 over a tax year, then yes, you need to be aware of these changes. Okay, let's talk about some of the pros here. So the pros here are as follows. Firstly, the structure is really simple. You do not need many legal compliances to do. No incorporation is required. You do not need to comply with many legislations, right? Uh, except some of the legalities that you need to follow depending upon your business, because if you are in a property business, then you would surely need to comply with your councils and different types of borrows. So for that you need to comply with their legislative requirements. But apart from that, like limited company, we do not have those confirmation statement and annual filings, because all the profits are taxed to the individual, right? There isn't separate business tax. Next is setup. It is very easy to set up. The cost is really low. You can start your business. Let's say I recently started my business and started without any uh, high compliance. Okay. Next is privacy. This is an advantage of a sole trader, because let's say I started my business recently. I don't want to show my numbers, right? I don't want to show my numbers to others, right? My competitors in the public. I don't want to show that, right? My creditors would know how much profit I am earning, right? My competitors would know. So here, as a sole trader, you don't file public accounts, right? You just report your income and expenses to HMRC for taxation purpose. You are not filing in the uh, company's house, right? So the information that you have is private. The accounts are private. Your competitors do not know what are the profit. So this is especially great for some startups, right? When they start out, they can choose sole trader. Okay, so that your financial information remains private. The compliance, as I said, is minimal, right? You file annual tax return, the individual tax return that you file. Credibility is bit of a issue here, right? It is suitable for small, but as you grow, you would like to establish yourself as a limited company, because let's say I have a company, I have a limited company, and my other competitor is acting as a sole trader. So the trust factor is higher with the limited company, right? Because there is full public records that are available for that particular company, right? So the trust factor usually increases. Retention, okay, you retain all the profits. I don't think so it is a pro, like it is a benefit. uh, it might be sometime, because everything is every each and every profit that you are earning is with you only, right? and you are retaining all of the profits, right? You are getting all the profits. You are not liable to corporate tax or any business tax. You directly pay the individual taxation. You report your income in individual taxation. But the most part of the retention is a disadvantage, because my business would require certain cash flow to be retained in the business, right? But as a sole trader, I am taxed on that tax year. All the incomes, right, that I've earned, I would be taxed on the same tax year. I am not able to keep certain reserves for my next tax year, right? I would be charged on that same tax year in which I am earning. Can't say that I would need to retain the profits. So as a limited company, although you incur corporation tax, you have the benefit of keeping and retaining your profits, right? So this can be a disadvantage. Liability, as I said, the liability is unlimited. Your personal assets are exposed to business risk and debts. Tax planning, there is a limited flexibility, because anyways you are filing tax under income tax rates, right? There isn't any scope for different shareholding or any type of salary and dividend structure that you can keep. So yeah, the tax planning part is almost vanished here. Exit is a bit difficult, right? Because it would be difficult to legally separate you and your business, right? It might be like that your business is running due to your name, right? So any person buying my business, right, might not benefit from it. Okay, because this business has currently my name attached to it. My customers, right, they know me. I have a relationship established, right? And if they want to establish a value without me, it will be difficult. But for a limited company, it is better, because they know that limited company, right? Because the director is separate from them. But for a sole trader, it is difficult to separate the business and the owner, which is why it is difficult to value the business. Okay, profits, as I said, is a bit disadvantage to retain, right? It is suitable for freelancers, consultants, some small businesses, service businesses, low risk and low investment ideas and activities, individuals who are testing a new business idea. Okay, yeah. This is an important thing, because when you establish a company, when you incorporate a company, you are going to pay certain fees, right? You are going to have paid up share capitals, or maybe unpaid share capital. But as a limited company, there are many financial aspects that you need to consider, because you would comply with the company's house requirement. You would need to file accounts with them, right? You will file corporation tax return. You have confirmation statement. Yeah. So as a new business, I don't have that much ability to pay off this type of uh, different compliance things, right? So yeah, it is a great option for me if I'm going to start out and I'm just testing the water, right? If it is good to enter. But once the idea works, I am always ready to incorporate my business later on. Okay, so these are some of the pros, cons, and suitability for sole trader. Now let's talk about another kind of structure, which is partnership. Okay, so partnership, as its name suggests, again, okay, is a business which is owned by two or more individuals. Okay, so they share profits and responsibility. So as a sole trader, I was the only one who was getting profits from my business. But when I bring in a partner, we both will be distributing our share, right, based on the agreement that we have, right? It is not a separate legal entity again, right? It is not a separate legal entity. Still, it is like the income tax is still the income that you are earning from the partnership is still going to be filed in your annual tax return, in your individual tax return. Instead, there isn't any business tax again. There is no partnership tax here, right? So you take the partnership total income, then you break it down between each partner, and then each partner books that amount into their self assessment, and you pay tax again on the basis of the slab rate in which you fall. Okay, partners are jointly responsible for the business obligations, right? So all the partners are jointly responsible for the business obligation. My liability is bit of now distributed between partners. Okay, so if I, but the unlimited liability factor still says, it still stays, right? But it is distributed between my partners. Okay, what are the pros? Again, simple and relatively low cost to establish. The profit sharing ratio can be agreed freely. Again, no filing of accounts. The compliance is still moderate as compared to limited companies. Credibility is bit more stable because we have now two owners. They both have their brand value and they both have their relationships and customers. If we talk about cons, again, unlimited liability, but separated by partners. So each partner is liable for their debt. Exit is dependent on partnership agreement, and it is difficult if sometimes dispute arise between the partners. So yeah, exit is bit of difficult here. Like it is one of the limitation. Retention, uh, profits are again taxed as a sole trader. What we were doing is that we need to report all the profits that we have earned during the tax year. We can't retain anything in the business and say that I'm not going to pay my tax on that portion, right? Okay, so you cannot retain the profits in the business. You are taxed on the same time, right? Credibility, it may have lesser professional image if they are wanting to have larger clients and bigger portfolio of clients, right? It is suitable for family businesses, small professional practices, business requiring shared expertise, right? So let's say I want to start a service business. I'm a lawyer, but I need someone uh, who can accompany me, right? I want to have someone who has better expertise or similar level of expertise like me, so that we could run the firm together, right? Both of our expertise combined could run the firm together. Okay, so that could be a great way to start with. Next important business structure is LLP, limited liability partnership. So yeah, here the limitation that we had in sole trader and partnership is removed because you have now limited liability protection. Okay. So limited liability partnership is a separate legal entity. So now here the separation arises. You are uh, filing your accounts, right, at company's house. You are registered at company's house. So it has a partnership of, it has a feature of partnership, and it gives all the limited liability protection that partners need. Okay. So members manage the business, but liability is limited to their contribution. So the capital that they bring in, right, and the liabilities again dependent on them only. The pros are separate legal entity, the liability is limited, so members are protected here. Credibility is bit higher because again you are acting as a limited liability. You are not a sole trader or a partnership. Now you have a separate business entity. Okay, the formal incorporation is required, so it gives a structured governance. Cons are here you need to comply with some of the requirements, annual accounts and confirmation statements. Uh, Again, the privacy, right? The privacy part is bit of a limitation here because you need to file all the annual accounts with company's house. Every data is available to the public, right? And it depends on the accounting policy that you use, not the accounting policy, the accounting standard that you use, FRS 102, 105. Based on that, it depends like what are the information that you are providing to the stakeholders. If we talk about retentions, profits are taxed on members even if retained. So it is a similar tax position that we get in the partnership. It is suitable for accounting firms, law firms, architectural practices, professional partnerships who want limited liability. Okay. The final one is limited liability, and which you mostly are waiting for. So, limited liability, LTD company, limited company is a separate legal entity incorporated at company's house. It is owned by shareholders and managed by directors. So, here is a it is a distinction. Okay, the director is different, my company is different, right, and the director is different. So my furniture business is this, right? Let's say ABC Furniture, like let's say my name Harsh Furniture. Okay, let me be happy for some period of time. Harsh Furniture and Harsh is different, right? Harsh is the director and Harsh Furniture is the business, right? I have my own tax to pay and my business has own corporation tax to pay here. Okay, So the company is legally distinct from its owner. The pros here are you have a legal entity, you are completely separatable from your owners. The liability is limited. So liability is limited to the unpaid share capital that you have. Credibility is higher here. So if you want bank loans and investors or larger clients, the sole trader might not be a good option. You would need to choose limited company. The tax planning is good thing here because you need to have a flexible structure via which your salary, dividend, and retain earnings, like the way you arrange it, so that the tax position is relatively lower at the end. Okay, but you have the tax planning aspect here. Retention, you can retain the profit after paying corporation tax. It is up to you, either you are taking salary or dividend, but everything could be retained in the business after paying CT. Exit, the business can be sold easily by transferring the shares. The limitation here are the compliance burden are higher. Okay, so if you are someone starting out, it might be a burden for you. So account CT600 confirmation statement is required. The privacy is bit of a problem here because yeah, you are reporting every financial details to public, right? You file your accounts, company's house. Okay, the setup is complex and costly as compared to sole trader or partnership. As said, the administrative complexity is higher. You have to set up a proper structure. Corporate governance should be in place, different documentation. If you give dividend to director, there should be a proper documentation. The payroll needs to be run, so it is again a compliance matter and administrative matter that you need to consider. Double taxation risk. Uh, so here the risk arises because you pay, let's say, taking a main rate of 25% of corporation tax. So again, in CT you have 19%, right, till 50,000, and about 2 lakh 50 you have 25%. In between that you have marginal relief available. Okay, so firstly, let's take the main rate for the sake of easiness in this calculation. Here, you would pay 25% tax on profits that you have earned in the business. And then again, when you withdraw your salary as a director, when you withdraw your salary or either take dividend, you are going to pay tax on that dividend income as well as your salaried income, right? So there are two types of tax. Firstly, the corporation tax and the amount that you have got, and the amount, the last amount that you have got in the company. And if you want to withdraw it completely, then you would be charged again in your individual tax return. It is suitable for growing business, right? It is suitable for growing business, high profit business who are seeking investment, because yeah, it would be a better option. Startups who are planning expansions. So when you start out as a sole trader, but you think that you have grown enough, then you can choose limited company. Owners who want limited liability protection can choose limited company. Now let's get to the final part of our video, where we are going to see side by side which one is better financially. Okay, this calculation is for a business with profit of 50,000 pounds. First, here is sole trader and here is limited company. Okay, so as a sole trader, let's say I'm earning a profit of 50,000 pounds. So I'm going to pay personal tax. I have got personal allowance here. So the amount which is left, I'm going to pay 20% tax on it, right? So I paid 7,486 as a income tax, right? And again, NIC, class 4 NIC is what you need to consider. So the total tax is 9,732 pounds. What is your net take home salary after that? The net take home salary is 40,268 pounds. Okay. Now let's compare it to a limited company. When you are a limited company, you have a profit. Let's say you have a profit of 50,000. Let's say I take salary such that my personal allowance is being used. So let's say 12,570 is being used here. So you have a taxable profit of 37,430. And on that, because salary is deductible expense, it reduces your taxable profits. So you took the salary, and what is the reason behind taking 12,570 as salary? Because you cover up the personal allowance, and over and above that, you can take up dividends, because dividend rates are typically lower than the other savings and non-savings income rate band. Okay, so you have post-tax profit here as 3318. Okay, now I'm coming to the personal tax that an individual has to pay. So you have taken dividends of 33,318. So after taxing the corporation tax, we have post-tax profits of 33,180, and this whole amount, let's say, I have taken as a dividend. Okay, so when I take a dividend, I have dividend allowance of 500. I reduce that, and on the above profit, right, I have to pay 8.75% tax because I am still in the basic rate band. I would be going to 8.75% of tax, which is going to increase going forward. Yeah, it is going to increase going forward. So yeah, you need to think about it, and incorporate it into your tax planning for the future tax years. Okay, so it is the total tax I paid is 9721. In the sole trader, I paid 9732 pound, and here I am paying 9721 pound. Right, my take home is better off as a 50,000 pound earning business. Right, my take home here is 2268. Here I am getting 4279. So it is almost the same, isn't it? It is almost the same, right? Okay, but the difference here is that uh, for a limited company, I am sure that most of the business would retain the profit. Okay, the director would not withdraw this whole amount of profit in the same tax year. You are not going to do it because your business requires the investment, right? So you can retain the profits. So if you retain the profits, you do not need to pay the personal tax. Okay, so limited company is better if you are considering retention of your profits, right? It is a better off deal. Let's say my profits doubled to 1 lakh pound. So I can do any manifestation, right? Manifestation is good thing, right? Let's hope I have 1 lakh pound of profit. Yeah, right. Okay. So here your profit is 1 lakh, you have personal allowance, you have taxable income of this. Now here, yeah, if you might be wondering that in the 50,000 calculation as well, in the limited company, we have not considered the NIC that we need to pay, right? But NIC, I am hoping that we have employment allowance which could cover it. But it has again some requirements. I have made a short video which you could check out to see what are the requirements for NIC, right? NIC and employment allowance. So with a 1 lakh profit, your total tax burden is 3689 pounds. So net take home is 69311. Compared to that, if you are going to establish a limited company, your net take home is 67,100. So it seems okay. If it is like that, you may think that here the sole trader's position is better off, right? But again, the retention part, I would say, because you are not going to withdraw this whole amount of profit anyway, isn't it? Right? And there are other ways that you can save your tax. Okay, you can either have two-person, right? You can have yourself and your wife as a shareholder, right? You can have you and your wife as a shareholder, so you have got two personal allowance. So the change in the tax position would be drastic here, right? You would save much tax here if even if you withdraw all of the profits during the tax year, right? There are other ways of saving tax, right, and getting dividends, right? So there are many tax planning possible in the limited company, right? This example we just saw is just a simple calculation of how we can withdraw profits from our company and what are the tax and what are the net take home, right? But there are many calculations that we could make after this so that our tax liability is lower. So there are many ways to save the tax. Let's hope that this video help. If you want tax planning part as well, we can cover that. But if this video has got some good amount of interest, let's say around 500 views, or some of your loving comments, right? Some of your awesome comments that you want this videos, then I would be making that video. Or else, or else, I guess I would try to make short videos because the retention is really lower as of now with people, right? They would scroll the reels, but they can't watch this longer video, as I've said in earlier videos as well. So let's see if our audience are good enough, or they don't have a they don't have dopamine, right? They don't only want to watch reels, they want themselves to grow. Then this type of videos might be for you if you are working in UK accounting or any accounting field, or you are pursuing your studies, you are taking up an accounting degree, right? This might help you. And even if you are a business, then this type of video could help you choose your business structure. Okay, so yeah, this is what uh, was for today's video. Let's conclude this videos. Thank you so much.